Hello, everyone. Today on the Final Bar, I'm talking to Mary Ellen McGonagle. We'll look at some themes and individual groups that Mary Ellen's looking at. We'll also talk about this choppy market environment netting out to a positive move today. The NASDAQ up over 1.5%, the S&P up about 1%. Interesting rotations as well, with energy stocks selling off aggressively, utilities and healthcare at the top of the list today. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using data visualization techniques and the best of the technical analysis toolkit to better quantify investor behavior, better understand market dynamics, and learn the lessons of market history, hopefully. One of the great benefits of doing this for a while is you've experienced previous cycles. You've experienced previous bull and bear market cycles. And I was told that the markets don't repeat themselves, but they often rhyme. And you're certainly seeing that now. You're seeing characteristics that are fairly common to bear market phases. In general, it's a lot of distribution, a lot of negativity in terms of breadth, sentiment that rotates to wildly negative levels. We'll look in a little later in today's show. We'll do a segment on called Getting Sentimental. We'll look at particular sentiment indicators. The name exposure index, one of the lowest levels we've seen in the history of the data series. So a lot of interesting data points to break down in today's show. Let's get to our upcoming calendar. I'm excited to talk to Mary Ellen McGonagle, one of my favorite guests and one of my favorite stock pickers. Always has a really good sense of what groups and names we should be focused on. Coming up next week, Monday and Tuesday, we're taking off from live shows as we juggle vacations here at StockCharts TV. But I have two special events that we've lined up for you. On Monday, increasing your use of technical indicators. On Tuesday, how to find stocks with strong signals. Then on Wednesday, the 29th, we have Samantha Leduc from Leduc Trading. She's a great macro strategist, always has some interesting perspective. And then on Thursday, the 30th, Sean McLaughlin, who's the chief options strategist at All Star Charts. Always some interesting options ideas on how to play this. It'll be interesting to talk to him about how to be defensive, how to rotate back to more offensive options plays when the evidence presents itself. Let's continue on today's show with our market recap. Let's look at today's price action. What happened today versus the overall trend? Net positive for the most part. Let's look at the charts together here. The S&P 500 finishing up about 1%. Just below 3,800. What's interesting is yesterday we rallied right up to 3,800 and gave a lot of that back going into the close. Today we sort of recovered back to those same levels. So still within the price range that we've been the last couple of days. No real upside progress, but continuing to finish near the highs of the day or certainly higher than the open, which is encouraging. The NASDAQ composite up 1.6%, mid caps and small caps all up as well, but the large caps led the way higher today. The VIX a bit higher as well, just above 29. And we're going to look at the VIX a little later in our sentiment focus, where we'll talk about the VIX and some survey data and other things. We talked about how the VIX is in the volatility. I tend to think is in a regime. I think of it as volatility regimes. What's low and what's high for the VIX is usually pretty specific to the period that you're in. And the ranges can fluctuate. 29 is actually kind of mid-range from where we've been the last couple of months. I'll show you the chart that sort of paints that picture pretty well. Interest rates off a bit, although the 10-year yield remaining above 3%, around 3.07. Long bond yields a little further above that. The dollar index, not too different from yesterday, up about 0.1%, so no real change there. All the commodities that we track on our dashboard in the red today, with the DBC, which is a broad commodity ETF, but a good amount of energy exposure in there, down over 2%. Gold and silver down as well, with the silver ETF SLV down at 2%. Energy, by the way, was the worst performing sector by far today relative to the others, continuing that pullback phase for charts like DVN and FANG and others that we've been talking about recently. Finally, a lot of green on the crypto charts, which is a nice change of pace from what we've seen up until now. Interesting to see Bitcoin bouncing off of 20,000. We've talked a lot on the show about big round numbers, why they tend to come up a lot when you're looking at individual charts, very simply because behaviorally we tend to focus on those levels, more psychological. We sort of dial into those big round numbers. So I'm not surprised to see Bitcoin bouncing off 20,000. Nice encouraging run going into today's equity close. And again, the challenge is you start breaking a level like 20,000, you have to start looking at the next one down. That's where we can start to get some more and more aggressive downside targets to make sense of things. Just briefly, let's look at a chart of the S&P 500, then we'll finish off our market recap looking at some different themes. I think of the market in different time frames. I did a presentation earlier today for the Money Show Virtual Expo, and we talked about one of the weekly charts that I look at first thing every day. And I think of the market in different time frames. A couple of years as sort of the long-term time frame, a couple months as the medium-term time frame, and a couple of days to a week or two as the short-term time frame. And I think investing for a lot of people should be about the interplay of those different time frames and understanding where you are trying to focus, but understanding as well that others are playing on different time frames, and the markets net out all of that supply and demand on those different time frames together. So when I think of the short term, like the tactical time frame, the real sort of day-to-day movements in stocks, I'm seeing some signs of encouragement. The last 3 days, really the last 4 days, we've closed above the open every day on the S&P. That's a minor thing, but it's kind of encouraging. And actually, if you switch to a candle chart on the S&P, which I'll do here very briefly, you can see sort of the white candles on here. And one of the reasons why candle charts can be so helpful is because the up and the down days almost jump off of the page at you. It's hard to miss the dynamics when you look at just the intraday movements, right? Did we close above or below the open every day? It's sort of, it's very clear looking at the candle charts. So now we've had 4 days in a row with a nice bit of accumulation. Now, that's not to say we can't just stall out, which is why we always look at where we're at relative to key support and resistance levels. So when I'm looking at a chart of the S&P 500, I'm encouraged by the last couple of days. I have a wary eye at that 3,800 to 3,820 range. That was sort of the key level we've been focusing on for quite some time. That's a 38.2% retracement of the way all the way back down from January 2022, all the way down to the March 2020 low. Take 38.2% of the way down. It's right around 38.10 to 38.20, depending on how you measure it. So now we bounced off of that support level. We broke down through that support level, and now we're trading right back up to that level. If I was drawing a picture of the basic bear market behavior, this is kind of what I would do before a big move down. To be honest with you, it'd be a breakdown of support and then retesting that support level from below. But that's why we pay attention to the lows. Can the S&P regain 3,800, 3,820 and continue to make some progress? Put in a higher low, represent that buyers are actually coming in. As a trend follower, I'm skeptical of bounces until I see enough evidence that tells me that the trend is really reversing and we're seeing signs of accumulation. What's interesting looking at sectors today, by the way, and I'm excited, we're going to talk a little bit about healthcare with Mary Ellen McGonagle. I'm excited to hear her take on that space because you've seen a bit of a bounce there. But I'm also noticing that the 3 top sectors outside of healthcare, then utilities, real estate, consumer staples, all up about 2% plus. So while I'm excited at the S&P rallying, utilities and REITs and consumer staples at the top of the list does not excite my bullish sensibilities. That makes me more cautious, thinking, all right, this is people rotating from previous leadership of energy potentially to some of the more defensive stuff. And maybe this is reinitiating some defensive posturing for a further bear market environment. But that might be the skeptical bear side of me coming out and interpreting the action as such. For whatever reason, utilities, healthcare, real estate, consumer staples, all having a pretty decent day. What did not? Energy and materials. Let's look at a couple of those charts together. And we look at the stocks that are up or down. You can get a sense of what's happening. The most down in the S&P list, it's a lot of materials and a lot of energy. And again, let's look at a couple of these. Mosaic is one of these. And what's interesting about charts like Mosaic, among others, these are previous high-flying names. If you go back to March, April of 2022, we were talking about charts like Mosaic because they were making new highs while the S&P was failing to do so, right? So every month you get a new high in Mosaic, you get a lower high for the S&P. What a juxtaposition of 2 very different price patterns. Same with energy, right? Energy looked a lot like Mosaic, sort of pushing onward to the upside. What's happened in the last couple months, though, is Mosaic's pulled back to its 50-day moving average and then broken it. now testing the 50-day a couple times and being unable to recover it, now breaking below the 200-day moving average for the first time in about 2 years. Last time we were this, below the 200-day moving average was back in July and August of 2020. So we've had this nice long uptrend on charts like Mosaic, now rotating below there today, down quite a bit, almost 10%, which is a pretty major give back. But this is just the latest move among a series of down days and down weeks as we've given up the all-time highs in April and now made lower highs in the 10 weeks or so from that point. You're also seeing pullback in some of the energy stocks, and we talked so much about energy and the leadership. One of my general thoughts on the bear market in 2022 has been, obviously the FANG sectors, technology, consumer, communication services have been struggling, certainly on a relative basis, but things like communication services very, very much on an absolute basis as well, while energy has been continued in an upturn, right? You look at DVN, you don't really get any sense that the market is anything but positive until the last couple of weeks. Now you're seeing DVN pull back. Instead of coming up, making a new all-time high during the week, now we're testing lows. And if you look at a lot of these names like DVN, like Diamondback, which is FANG, we're finding potential support here. We've pulled back in FANG's case to the 200-day moving average where we bounced off of there before. We're also pulling back to a key level of support. This is a really interesting point for some of these energy charts that have been doing so well. Is this a brief pullback and an opportunity to reinitiate as the uptrends continue? Or is this the final recognition of the bear market where energy stocks have become overheated and people are just starting to get defensive? After the break, we'll look at a lot more charts and try to answer those questions. Together, we'll be back in a minute with Mary Ellen McGonagle. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts and the technical analysis toolkit to better understand what's happening around us. A couple quick announcements before we get to today's guest, Mary Ellen McGonagle. First off, we welcome your questions. We have a mailbag segment, which we'll be doing on tomorrow's show on Friday. We've gotten so many great questions from you guys over the years, and we would love to hear from you. What are you struggling with as you're trying to analyze your own charts? Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. Today's guest, Mary Ellen McGonagle, does a fantastic job with her weekly show, which is featured on StockChartsTV.com. You also have all the special events and special broadcasts. We have Larry Williams did a market outlook a couple weeks ago. Tom Bowley last week, we were talking before we went live, made the big bull call saying the markets are bottoming. You can digest all of those videos, come to your own conclusions. Go to StockChartsTV.com or on your mobile device, just search for StockCharts TV on demand. I want to welcome on today's guest, Mary Ellen McGonagle. Mary's been a frequent guest on StockCharts TV for sure, but on our show, The Final Bar, as well. She's the president of MEM Investment Research, coming to us from Southern California. Mary Ellen, it's great to see you.
Great to see you as well. Yes.
So I couldn't help but mention Tom Bowley's super bullish call. What is your take? We have your monthly chart of the S&P 500 starting here. Give us a sense of your perspective.
You bet. So I'm pulling out the monthly chart on the S&P 500. It is taking us back to two of the more severe bear markets, the 2000 into 03, the 08 into 09. And what I use this for is a reminder. When we see the RSI on a monthly chart turn negative, it does not occur that often. We can see the more brief 2020 bear market. It did dip below, likewise with 2018. But a more pronounced RSI that's negative, coupled with a negative stochastics, going back to those lengthier bear markets, that was the hallmark. The stochastics turned negative when the S&P was at about 13% negative, both in that 01 and 08 period. We're now, of course, 20% down on the S&P 500. And really, it's a reminder that when what is taking place currently, it has been historically a precursor to further lows. Now, of course, I do not want that to happen. It is not something that really any of us want to see, but it is something to keep a good eye on. I do a lot of more work as it relates to identifying a market bottom. That's much more my expertise. I do have a system. If we can take a look at the daily price chart on the S&P 500, just wanted to point out that this year in particular, rally attempts on the S&P 500 have pretty much taken us right to that green 10-day simple moving average, that purple 21-day, right up to it and a little bit above before we falter. We did have a follow-through day in March as well as in May. Both of them failed. They failed rather quickly, but that's what I'm on the lookout for now. Can we sustain a move above these shorter-term moving averages as a guide, a first step guide that we could be at the very least bottoming out before reversing? Subscribers to my MEM Edge report, I'm all about looking at additional dynamics in addition to the price charts.
I love that take, and I love the idea, Mary Ellen, of having more of a systematic process, a model to help you just digesting, because it's so easy to get caught up in the emotion of these sorts of periods, as you well know. Now, you brought some healthcare charts with you. Healthcare is one of those spaces that have bounced a bit this week, right? And even from last week. What's your take on biotechs first?
You bet. So biotechs, this is really interesting to me. It's a risk-on category. It's not an area that does well, certainly in a bear market environment, but we are seeing vibrancy. It picked up last week. It was a down less than 1% in an otherwise dire market. Biotechs are really excelling again this week. And we can see the break back above that 50-day simple moving average RSI in positive territory with a nice MACD positive crossover. As a side note, biotechs, there are 800 biotech stocks out there. Only 28 of them actually have earnings. So of those 28, there are actually a significant number that are outperforming. Biotechs are up, I'm going to say maybe about 6% this week. There are stocks that are larger, that have earnings, that are charging even higher than that this week. So interesting dynamic. If we take a look at another area in healthcare, the big cap pharmas have been on the move. Take a look. You can see another area where it's broken back above those simple moving averages. Not a whole lot on the volume, but we are getting the stochastics and RSI up there in positive territory. And there are dynamics taking place among these big pharmas that are capturing institutional interest. Among them, these biotechs are consolidating. They are spinning off areas that are maybe heart-related, diabetes, that are more generic, and putting all their efforts into these more focused areas, whether it's oncology, other big growth areas. And the markets like that. You're also getting a nice yield. You talked earlier about a move into defensive areas. So there is a little bit of that as well. But we can look at Eli Lilly. They just came out with earnings last month, very strong. And the company introduced a obesity drug that is also designed to help with diabetics, and growth prospects are very strong there. So a lot going on that I like in healthcare. I'm expanding my watch list among stocks in that area.
Lilly's one of those charts that's holding up so beautifully in 2022. And I'm immediately drawn when I see a chart like that, how different it looks from sort of the average name out there. We only have about a minute left, Mary Ellen, but since we do, I'd love to ask you about some of these energy names like DVN, like FANG, I was mentioning in the market recap, really starting to pull back, sort of like healthcare flipped over in a lot of ways. If you flip over the biotech chart, that's kind of what we're looking at. Is it the time to be unwinding, positions that you've been, joyfully riding higher, or is this an opportunity to leg in? How do you approach energy in this sort of environment here?
Yeah, energy I picked up on January 4th of this year. I had Devon, OXY, a number of the big winners, and about a week and a half, actually a little over a week ago, I subscribed lightening up on positions at that time as the group was starting to deteriorate. A lot of this is the economically sensitive areas, basic materials, industrials, energy. All those areas in light of a potential recession are receding. So if you have not already, yes, lighten up. It is not an area to be overweighted as it was earlier this year.
Mary Ellen, it's a pleasure to see you. Thanks, as always, for sharing some expertise with you. Stay safe down there in California. We'll talk to you again soon.
Sounds good. Thanks, Dave.
It's Mary Ellen McGonagle. Mary's the president of MEM Investment Research. Her background, we didn't have a chance to talk too much about it, has a lot of experience working with William O'Neill and his methodology, and you can just pick up on that great expertise as she's talking about stocks and groups and themes. I love that idea. When I talk to Mary Ellen, I always take away these rotational ideas. What had been working, which is not now, and what had not been working, which is sort of starting to rotate higher. I jotted down biotechs, IBB, to dig into a little bit further. Also, again, what I love about talking with someone like Mary Ellen is she's had great experience of sort of navigating these sorts of environments. Before we went live on the show, we were talking about just the general sense of being optimistic or pessimistic during these environments. I've enjoyed bear markets so much more than bull markets because you learn a ton. This is where you're educated. This is where the market can teach you a lot about money management and capital preservation. So I hope you're able to trade safely, invest well, and continue to learn the lessons that the market can provide. Great take there from Mary Ellen McGonagle. Let's continue with our next segment, getting sentimental. Let's focus on the activity of the latest indications of sentiment indicators, which I tend to put in a couple different buckets. One of them would be volatility data. So we'll start with the VIX. Then we go to survey data, things like the AAII survey, and we'll look at put call ratios if we have time at the end. We'll start with the VIX. So the VIX has been coming off a bit recently. It's currently just below 30, right around 29. And these shaded areas that I have on my chart of the VIX are just trying to illustrate the different, what I would call volatility regimes, right? I always sort of cringe a little bit when people talk about the VIX and have a particular level. If the VIX is above 20 or below 30 or whatever it is, then XYZ, because the way I see it, it's more volatility regimes. The VIX tends to sit in a certain range for about 6 to 12 months, and then it rotates to a new range. And I think that fluctuation in the volatility tells you a lot about the character of the market. Recognizing when things are different can be really helpful. You'll note here how the VIX in 2021, particularly the sort of second and third quarter, relatively low, right? Pretty muted, between 15 and 20 to 25 on the upper end. Look at how that changed in November. A lot of things peaked out in November. A lot of measures of breadth and momentum. Even the NASDAQ made its high in November. So even though the S&P went higher, you can see that the volatility was telling you things were different. Things are actually fluctuating a little bit. From there, we've now sort of shifted the entire range of the VIX higher. On the lower end, we're at 20, at the upper end, around 30 to 35. So what's interesting is we are getting a bit of a bounce here in the last week, and this is after the VIX had gone above 30 about a week and a half ago, now coming back below there. In the last couple of times you've seen that sort of pattern, those have been the lows in January and in March and in May. Now, worth noting, these have not been incredibly long-lasting lows. These have been these short-term bounces before the next leg down, and that's what would concern me about any sort of short-term strength that we're seeing here. However, certainly worth noticing the VIX, if you continue to see a reduction in volatility, often would coincide with more of a constructive price pattern. When I'm looking at the chart of the AAII survey, the American Association of Individual Investors, in the short term, no real change, to be honest with you, from last week. It's about the same, a bit of a decrease in bulls, a bit of an increase in bears, and the spread between the two increasing just a bit, but it's not far off of where it was last week. Last week, we talked about just sort of this reinitiation of bearish sentiment. The spread between the two at 40%, 41% this week, pretty significant, right? One of the biggest levels you'd see in terms of bears over bulls. It's over it's about a 3-to-1 ratio of bearish respondents versus bullish respondents. That tells you something about the trend. And also look at the trend in the sentiment over the last year and a half. Just continued downtrend in bullishness and continued increase in bearish sentiment. What tells me or what I think is important about the AAII survey is that it's one measure of sentiment. It's one measure of expectations. Price is often the best sentiment, right? The best indicator of investor sentiment. Let's see if the price actually follows through on this incredibly negative sentiment, which suggests that investors are pretty despondent at this point. Speaking of despondency, in the name exposure index, which are the black histogram that you see at the bottom, and the red is the RIDEX flows, which we'll come back to in a moment. The name exposure index is a survey of money managers and asks them for their allocation to equities. What's your equity exposure? If you think on average, the average value of this index going back for years and years is around 70%, I would say. And that makes sense, right? If you think it's sort of a 60-40 split, that's about right. We'd be a 60 to 70% allocation to equities on average. going back for a number of years. We're currently at 20%, which is one of the lowest levels you'll see. Now, it has at times gone negative, gone below zero, but that happens incredibly rarely and only during the deeper market drawdowns. At this point, being down around 20%, the only other times in the last 6 or 7 years we've gone that low is in March of 2020, where we went below 20%, and also back here in mid to late 2015. We also obviously had a subsequent low in early 2016, but similar to Mary Ellen's chart, where she was showing, sort of the momentum characteristics of looking at 2000 to 2002, looking at the 2009 low, seeing a lot of similarities with the name exposure index, where you're seeing a real deterioration in positioning, showing you that money managers are at this point basically as defensive as they have gotten if you look back at the history of the indicator. That is our segment, Getting Sentimental, breaking down some of the sentiment indicators, where they're at. And again, not a ton of change from recent weeks, which have continued to show some fairly bearish sentiment on those survey and positioning data that we follow. We need to wrap the show, folks, and go to the 3 and 3. I actually think I actually made 3 minutes this time, which is kind of rare for me. I'm usually scrambling and finishing the show a little late. So let's get to them. Chart number 1 is the utilities sector. What's interesting to me is the relative strength of utilities. This is one of the indicators that I follow to just sort of track bear market phases. I found that utilities start to do well when investors are getting skeptical about risk on, right? When they want to go risk off, when they are looking more for the relative safety and the income component of something like utilities. These are names, some of which you might know, like Southern or others, but a lot of the names you probably don't. You probably get a bill from them, like First Energy or something. You don't think a lot about the equities because we're so used to talking about other parts of the equity landscape. These are names that tend to be very low volatility, fairly stable, so not a lot of movement, but also fairly defensive because they have a decent income component. Now, the income component of utilities has become less attractive as interest rates go higher, because all of a sudden you could be better off just owning a treasury bond, right, than getting the income that you would get from a utility stock. But the relative strength overall has been fairly strong, certainly since November of last year, which I would consider a sort of, for all intents and purposes, the top for equities. What's happened in the last month is you've seen a pullback in utilities along with some of the other areas of the market. It'd be very interesting to see if you see the relative strength improve, which would tell me that investors are still trying to get defensive and go to that part of the market if they do have equity exposure. Essentially, flip that chart over for the last 6 months, and you have the chart of the XLK, the technology sector. At the bottom, look at the relative strength of the XLK, continuing to make lower highs and lower lows. Look at the price action on technology stocks making lower lows and lower highs. I guess yesterday we were talking about Bill Baruch. We were talking about the trend in the Qs, and basically, expecting that the market recovers when the big mega cap tech and consumer names can participate. Charts like Meta are making new 52-week lows, not rotating higher. So you are seeing a bit of a bounce in technology. I'd love to see more of a rotation, meaning being able to recover key moving averages, making not just a bounce higher, but a higher low when you have the next pullback, and seeing the relative strength turn higher a little more than we've seen so far. So the XLK, the XLU at the bottom, that was the relative strength of technology versus utilities, and might be an important one to watch as well. Finally, FANG, which I asked my guest today, Mary Ellen McGonagle, on the energy stocks at the end there. You've certainly seen some weakness. I think a lot of these charts are at key decision points. If you look at the chart of FANG, take the low from March of this year, lines up with the low in April, also lines up exactly where we were at today. We're also right at the 200-day moving average. So a chart like FANG has had an incredibly solid run, has even made new highs just a couple of weeks ago, new all-time highs, but now it's pulled back. Now you're seeing a rotation away from these energy stocks. Stocks like FANG have just barely touched the oversold level. Some of them are flat out oversold now, but I think this is the line to watch. A chart like FANG breaks below 115, we'll call it. That would take it to a new low for 2022, or very close to that. Also would take it below the 200-day moving average. That really indicates a rotation away from energy into other places. As always, focus on opportunities to rotate in to stocks showing strong relative strength. Folks, that's our show for today. I want a special thanks, Mary Ellen McGonagle from MEM Investments, joining us from California. Also, all of our previous interviews are found at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm David Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.